Thanks for jumping back into Lamb's cryptoverse, or maybe I should say macroverse, because like I did in a video last week, crypto is macro and macro's crypto. So you got to pay attention to what's going on in the economy. And as you all know, we had an ugly market today. I'm going to go to the screen to summarize everything, and it looks like the Dow was down 2%, S&P was down 2.8%, and the Nasdaq was down nearly 4%. And what's scary is, we don't have it here. Let me go to another page. What's scary, I was going to say, is the VIX is only at 31. And if you go back over the last year, the Nasdaq already surpassed its lows, its 22 lows, yet the VIX hasn't even reached its 22 highs, let alone highs of 2020. I mean, look, the VIX was like, I don't know, 82.7. So we've got a long ways to go for fear. So there's a lot of people talking about how there's all this fear in the market, that there's a lot of retailers and everyone else and institutions fearful of the market, but they're not showing that. Okay, the put-to-call ratio has shown some fear, but other places like the VIX are not showing fear. So I want to talk to you today why the market was down so much. And you're going to hear me repeating things, but it's worth repeating because it's so important. So the market was down because the labor report, while weaker, was a bit stronger than expected. And I said in the previous video that if the labor report would just be a little weaker, the market could rally because the market could be anticipating lower rates and the Fed pivoting. But the problem is the economic indicators won't stop. They just keep pushing harder and harder. And here's yet another example. We had, I'm trying to remember what it was, 273,000 jobs created, more jobs created than expected. And what I wanted to focus to you on was this. This is unemployment rate. It went down. It was lower than expected. And I've got this long-term chart because I want to show you that I think we're at 3.5. What is it here? 3.7%. Previous was 3.5. The consensus was 3.5%. So we went over consensus. But what I want to focus on is if you go back, this is one of the lowest areas since the 1970s. So this is a very stubbornly strong economy. I mean, it's a good thing, right? But the problem is it's not a good thing if you're buying Cathie Wood exponential growth stocks or equities in general, or crypto for that matter, because the Fed is going to keep on tightening. And let me show you some more evidence. And this is from Trading Economics. Trading Economics has really good data, and I feel like it's reliable. And not only do they have data, but they have forecasts too. So for example, here's the non-farm payroll. I told you we were at 273. Actually, today we were at 315,000 jobs. And wait, is that right? No, I think I'm looking at, let me just go back to the videotape here. We're at 263 versus 255. And so this is old. But basically, what I like is that they put the actual versus the previous, but they haven't updated this yet. But they do give a forecast, which is good. So what I want to talk to you about is that the number was too low. And the number was too high. Yes, it's coming down, but it's still too high to make the Fed comfortable with becoming dovish. They want to see the economy get hit. They're not evil people. The problem is that the CPI, meaning inflation, is too sticky. And a lot of that source of stickiness is coming from wages, not just from commodities, from the manufacturing economy. It's coming from areas that are difficult to get rid of. It's difficult to reduce wages easily the way it is for lumber prices and copper prices, even oil prices, to go down. They're more volatile, and they've all been declining. As you saw, the housing market is at a very weak area now, and so housing-related material prices are coming down. But the Fed's not seeing that in the consumer side of the economy. That's why the only way the Fed can lower inflation is by causing a U.S. recession. I'm going to repeat it. The only way the U.S. can cause inflation to decline is by creating a U.S. recession. It's going to have to break a lot of things. It's probably going to break more things overseas, by the way, than it's breaking here, because the U.S. dollar is at a 20-plus year high. And remember, since the U.S. dollar is a reserve currency, there's going to be a lot of hunting for dollars when a dollar increases. And also remember that this is a financial economy, world economy, and so companies and entities need to refinance and roll over that debt. So let's go to the next chart. Okay, speaking of what I was just talking to you about, average hourly earnings, they're just too high. They need to come down to about 2.5 to 3%. We're not getting there yet. We're at 3.5%, and the previous was 3.7. It's not down enough. It's not coming down quick enough. Like I said, it needs to go down somewhat rapidly in order for the Fed to ease off that accelerator pedal on being hawkish. Next, I talked about this. This is the United States inflation rate. We need this to come down substantially. I think it should come down to about 3 to 4% before the Fed eases. But the Fed is on the money, in the books, as saying it wants this data, this number, to come down to 2%. My friends, this is a hugely lagging indicator. If the Fed actually does what it says it's going to do, it's going to cause a depression, because by the time it reaches 2%, everything's going to be broken. Remember, it takes time for things to play out. Even when it rose, everyone knows inflation rose rapidly, but if you look here, it still took 9 months for it to rise from flat, or about whatever, 0.5%, up to 8 point something percent. It takes time. So if it's going to take that long to go up, believe you me, it's going to take even longer to go down, because, as I said, wages are sticky. And my last chart from Trading Economics is that the United States federal funds rate has had one of its largest increases in history, but rest assured, I hate to tell you, it can go higher. How do I know that? Because every single Fed governor has been out there on the street interviewing and speaking about those talking points, that they're going to keep raising rates and they're going to keep being hawkish. As a matter of fact, you can see from this is called the CME Fed Watch tool, that investors are expecting rates to rise by 75 basis points at the next Fed meeting in November. How do I know that? Because right here it says that there's a 79.6% probability of a 75 basis point increase. Now let's go forward. Let's look forward. Is this going to be the end to Fed rate increases? No. How do I know that? Because if you look at the dot plot here, and it explains to you, you could look at this later, but in the footnote here, it actually explains what circles mean what. Basically, each Fed governor is a dot, and the middle ones are the average dots. But you can see the average high dot is almost 5% in 2023. So my friends, it's going to be a tough market out there. I'm still expecting the soft data, at least, to start weakening. We already saw that with the ISM data, and I think the hard data is going to start weakening too, but that's going to be later on, like durable goods, industrial production, factory orders. That's going to be later on. So we might see a continued inversion of the yield curve, and I hate to tell you this, put on your seatbelts, because I think longer term, after this, we may get like a short covering rally yet again, but after that short covering rally, I think we're going to go down again, both for crypto and equities. So be careful out there, friends, and have a nice weekend, and please like us and subscribe to us. Thank you. Bye-bye.